Hey, everybody, it's July 26th. We made it to Friday afternoon, getting close to the weekend, and it's definitely been a kind of a crazy week that we've had at the market update desk. Bunch of deals going on, working hard to help people. Today, we got what the whole week was focused on personal consumption expenditure report, the PCE. That's the Fed's favorite measure of inflation. And there was a lot of rumblings about where this number would come in. Let's break that down and go through it here for you. So the all-in or headline inflation number for June rose at a 1/10 rate. That was exactly in line with estimates. Year over year inflation declined from 2.6 to 2.5%, which was also exactly where the expectations were. Now, what did help us out was energy costs fell 1% during the month, which is a very nice thing to see. Now, the core rate, which strips out the volatile food and energy components of inflation and is a main focus of the Fed, that rose 2/10, was slightly hotter than expected. The market was expecting and hoping for a flat reading, so it was a little bit higher than expected. Year over year remained stable at 2.6%. The market was planning on a decrease to about 2.4 or 2.5%. So it was a little bit of a disappointment in that aspect. Now, when we look at the last 3 months of a run rate, and that's the annualization of those, we're actually on track for 1.5% in headline and 2.28% in core. So that's the super headline and super core reading that the Fed likes to look at when they look at the most recent data and start to forward forecast that. Shelter, that big component that we all talk about and look at and have a lot of focus on, rose at a 0.27% rate in June. Now, this is an improvement almost by half of 0.42%, which was the previous month's reading. Year over year shelter now is up 5.35%, and that's a decrease from last month's run rate of 5.54. So we're continuing to see some declines or some catch up in that shelter cost. Rent rose a little over a quarter at 0.26 and is up 5.05% year over year, which is a decrease from where we were at 5.26%. Owner's equivalent rent, which is a significant portion or contribution to the shelter cost, rose 0.27% and is up 5.44% year over year, down from 5.62. So not monumental changes within shelter, but we're seeing consistent declines in that. And that was because of the weighting within all these inflation reports. It's just so critical that these rent renewal costs start to play into the shelter cost. And we're finally starting to see that trickle through. Now, the income part of the PCE was kind of intriguing. Incomes rose by 0.2, which was half of what the market expected of 0.4%. Consumer spending rose 0.3, which is in line with estimates. But the previous report was revised higher from 0.2 to 0.4. As a result of spending more than income, we do see savings continue to decline, and it fell 0.1% from 3.5 to 3.4% year over year. It's actually the lowest level of savings since November of 22. Bottom line, the PCE report was good, not quite what we hoped for, but it was okay. It's still showing decent inflation progress, which is critical to the Fed's decision for fiscal policy. The market is currently reacting fairly positively to this report. Even though the core wasn't exactly where we want it, the progress is being shown specifically through that shelter cost to help us out. Next week, there's going to be a couple things that could potentially help us out for a September rate cut. The Case-Shiller home appreciation numbers come out Tuesday. And believe it or not, it's going to be jobs week. So we get JOLTS report on Tuesday, ADP on Wednesday, and initial jobless claims on Thursday. and the BLS jobs report on Friday for July. We're gonna analyze those pretty tight, and we're gonna see if we continue that downward slide on job creations and weakening of the jobs market, because we're definitely seeing the weakening in the consumer spending portion of all these different reports. If we get unemployment down, we get inflation down, a slowdown in the jobs market, we get the path, we get the highway to maybe even more substantial cuts than what the market initially planned on. The technical analysis right now, we have improved today. We've got about 20, 25 basis points to go before we hit some resistance on mortgage-backed securities. So we got a little room there to run. 10-year bonds are trading in between 4.19 and 4.21. The next resistance level is at 4.17. So with a little bit of positive news next week, we think we might get there and get some better rates. We're working all weekend. We're happy to help you out, get pre-approved, make phone calls to try to get your offer accepted. Give us a call, 616-293-2189. Have a great afternoon.